Hey, Andrew here from the Investor's Way, and welcome to Woody's Weekly Wisdom, episode number 63. And today we're talking about jobs. And I want to actually show you how the media has, presented this story so you can get an idea of why we do these videos and why we dig into them a little deeper than just the headline. So you can see here today, I'm going to be talking about this one here. The Aussie economy delivers shock jobs boost. So that piqued my interest. So we come across to the actual story, and you can see the headline is now completely different. ABS reports 58,000 new jobs in July labour force data. And so if you've been following along, and I hope you have, and if you haven't been, make sure you subscribe and hit that little bell button if you're watching on YouTube, and if you're watching on Facebook or LinkedIn, make sure you hit the like, comment and share button so that more people can see this information. But if you've been following along for any length of time, you'll know that we've been talking about inflation and interest rates and all the things that impact the direction of interest rates throughout this year and what people are expecting them to do next year. And one of the things that has been a key consideration and risk factor when it came to interest rates was with inflation rising throughout 2024 and the end of 2023, there was a fear that we would see a whole host of pressure from employees for higher wages because, with inflation, it puts a tighter position in your financial household spending and income scenario. And so the only way to potentially solve that is to seek a rise in your wage. And so the federal, the Reserve Bank of Australia and the government were fearful that if inflation stayed high, that we as employees and would then be seeking over and above inflation wage rises. And we saw a little bit of it. This is normally where major labour force representatives will jump in and try and help the labour force get some form of result when it comes to increased wages. So we've been watching it very, very closely, and that, I guess, the pressure on wages is also driven by how many people are employed. And if there's a little bit of a gap there, then there's a belief or an expectation that there won't be that pressure on wages because people would just be happy to have a job. So there's a lot of this playing out in the market, and there's lots of chess playing going on between the inflation rate, the interest rates, and the employment rate or the unemployment rate. So to see this headline where we've got 58,000 new jobs in July, you would expect that predominantly that's good news for everybody. And as you go through, you'll see that within this article, there's a whole host of conflicting data, which is always difficult for people to interpret without some form of deep economic understanding of all the different factors. But basically, this story is all about the fact that the unemployment rate rose despite the fact that the economy created 58,000 new jobs. And you'd say, well, if we created that many new jobs, how did the unemployment rate rise? And that's where, obviously getting into the deep roots of economic data can be problematic and, to be honest, a little bit boring. But basically what's happened is, there's been 58,000 new jobs created, but the number of people who are unemployed or not seeking employment also rose. And so that saw 25,000 people in unemployed, or more, 24,000 more people unemployed than from the previous month, even though there was 58,000 new jobs created. And so, a rise in the unemployment rate, a rise in the number of jobs. To an extent, the increase of new jobs is great for the economy. The rise in the unemployment rate just allows everybody to take a deep breath when it comes to interest rates, and just continue to wait out and see what happens. Because with that unemployment there, the pressure on wages is not likely to be there, and therefore, not likely to drive prices higher as a result of the demand on wages. So it's all very, very convoluted, but effectively what this story is saying is that despite the movement in new jobs and the movement in the number of unemployed, we're still not at our highest ever unemployment rates, which is pre-pandemic data, and that we're adding new jobs at a good rate, which is great, and higher than expected. And so what that means for interest rates is that the Reserve Bank can kind of wait and see what happens, and just wait and see what this does with the inflation rate and different GDP data that's coming out in terms of the growth of the economy as a whole. So the argument here is that the forecasts and as to how big and when interest rates will come, they are changing based on this data. So previously the average that people were expecting was a 29 basis point cut to interest rates. That's now been reduced to 22, which is interesting in itself, because you don't see cuts of 29 or 22 basis points. It'll be either 25 or 50, and highly unlikely it'll be 50 the first time. And so, these are just averages of what people expect, either 0, 25, or whatever it might be. So, generally speaking, they're saying, likely that the first cut will only be a 25 basis point. And then the argument is, well, when will we get it? And it looks like people are now, economists are now forecasting that rate cut won't come until 2025. And in this article, one economist suggests not until the second quarter of next year before we see a rate cut. And all of this is speculation. All of it is based on future economic data results that nobody at this point can predict what they're going to be. I mean, there's plenty of people out there who are making predictions, but as we know, the predictions are nice to see, but very rarely accurate. So we just have to wait and see. I think, and the main reason why I wanted to talk about this article is that the new job creation is good for economic growth. Economic growth is good for everybody in this country. It just is, the economy needs to be growing in order to create jobs, to create abundance effectively for everybody. And inflation just means that it's growing, or prices are growing too fast. And it looks like that is being reined in. Certainly, if you look at data out of the US this week, their inflation rate has gone below 3% for the first time since 2021. So that's very positive for the US economy, and potentially will lead to interest rate cuts there before the end of the year in the US, although they do have an election cycle happening in November. So there's going to be a lot of pressure on the Federal Reserve not to do anything that could be considered election interference by reducing rates before that election. So it'll be interesting to see what happens there. And then in terms of Australia, the other factor we have to take into account, given our reliance so much on China, is what their economy is doing over the balance of this year and how that will impact our economy, and therefore all the flow-on effects of all of that down to employment, wages, inflation, and interest rates. So it's a mixed pot of everything going together to get us an outcome on interest rates. But as I said, the main thing to pick up from here is that fear that the government and the Reserve Bank had late last year, early this year about growth in wages. This data suggests that pressure is not necessarily there, and that is good for inflation and therefore good for a likely cut to interest rates at some point. And now it's just a case of when that will be. And I think what we can take from this data is that the potential risk of a rise in interest rates is diminishing as each new piece of data comes out. And so this data this article wraps up by just telling us that the next big pieces of information to come out are the CPI index indicator on August 28. So that's inflation. We've got retail sales coming out in August 30. So that will tell us how our businesses are doing in terms of sales. And then you've got the economic growth, the GDP growth, that's coming out on September 4. So end of the month, start of the new month, lots of important data coming out that will once again get everybody talking about what does all this data mean for the next direction of interest rates. So we'll be able to talk about that as it comes out. But this week, knowing that the pressure from rising wages seems to be under control, that is good news when it comes to the next direction on interest rates. And so we just have to wait and see what happens and when it comes. And as I've been talking to a lot of people this week, I think we're starting to see, and when it comes to your specific life and money, this is where it gets interesting. We're starting to see a shift in the power when it comes to interest rates and banks. So the banks for the last 18 months have had all the power. Rates have been rising rapidly, and they've been able to charge whatever they want in terms of interest rates without having to do a great deal of discounting or competitive shopping around. And I think that dynamic is going to start to shift as we look toward rate cuts. And we're going to see banks not passing on the full amount of these rate cuts. And that is going to put the power in your hands to shop around to get a better deal. And when that starts to happen, you're going to see a whole lot more offers from the banks to either retain you as a customer or convince you to switch banks to get a better deal. And I think that's coming very, very soon. So the dynamics are changing, and we're hopefully going to get some relief when it comes to interest rates real soon. And that's going to be good for a whole host of reasons and allow you to be more proactive with your investing, and hopefully for those people who have been struggling a little bit to have a little bit more in their week-to-week financial scenarios for investing purposes, hopefully. So that's this week's episode of Woody's Weekly Wisdom. I hope you found that useful. As I said before, if you're watching on YouTube, make sure you hit the subscribe button and the little bell to get notified when the video comes out. And if you're watching on Facebook and YouTube, there's the like, comment, and share buttons that I'd love for you to hit all three of them. And that just helps the algorithm and therefore more people to get to see these videos and to benefit from what we're talking about and how that applies to theirs, yours, our financial scenarios. Have a great week. I'll see you again next week. Cheers.